Okay, dear students, welcome to everyone in our live revision session of FR for your current attempt. A little introduction about myself. I am myself Abil Ahmed, CEO and Principal of Abil School of Accountancy. I really welcome every one of you in my live revision session of FR. In today's live revision session, we'll be discussing MCQs from IAS 21, IAS 37 and IAS 10 and then IAS 12. Every Tuesday we'll be having a live revision class on FR. Obviously, in every Tuesday we'll be discussing the different topics. Plus, I'll be doing one more thing. Today, the questions which we'll be discussing, not all the question I would say, but around 50% of the questions they are from Kaplan kit, 50% of the question they are from a different source. And then in the coming class we'll be discussing the question from BPP kit, and then we will also be discussing the question of study hub as well, so that in a very short period of time I'll give you the flavor of all sources of material which is available for FR. One more thing, today's live revision class, this lecture will also be uploaded on our Abil School of Accountancy YouTube channel, but only the first lecture will be uploaded. The coming lectures, whoever wants to join, more than welcome to join the class and come and take the class live online. Coming live revision classes recording will only be available to our enrolled students. So those they are not enrolled, they have the opportunity to take out the time and take the class online. Every Tuesday, same timings will be having the class. One more thing, any area of the FR which any one of you who wants us to revise, so we can revise that also during our live revision classes. So let's start from this IAS 21. In relation to IAS 21, the effects of changes in foreign exchange rates, which of the following statements are true? A little bit idea about IAS 21, quick revision. According to IAS 21, monetary items, all the monetary assets and liabilities, they're translated, number one, by using spot rate on transaction date. Any question? Yeah, every Tuesday, local time is 3 p.m. Pakistan time. Every Tuesday. Okay, monetary items, according to IAS 21, monetary items are translated on their transaction date by using spot rate, and then they are retranslated on each SOFP date by using closing rate. Whatever the exchange gain or loss comes on monetary items, that goes to P&L, income statement. Let's see. Exchange gains and losses arising on the retranslation of monetary items are recognized in other comprehensive income. False. Actually, exchange gain or loss on monetary items, they are recognized in income statement. They are not recognized in OCI. Non-monetary items measured at historical cost in a foreign currency are not retranslated at the reporting date. True. Actually, non-monetary items which you have kept at historical cost, there's no need of retranslation them at reporting date. So number one is false, number two is true. An intangible asset is a non-monetary asset. True. Actually, monetary assets means where the fixed cash is determinable. Actually, how much cash you will be receiving, you know that. For example, accounts receivable is a monetary asset. For example, accounts payable, trade payable is a monetary liability. These questions are from the Kaplan kit. Yes. I will share this PDF with you. Don't worry at all. I've already shared in the different groups. So after the class, you will get the PDF. So students, monetary items like accounts receivable is a monetary asset. Accounts payable is a monetary liability. If you have made an investment in equity instrument, for example, if your company bought the shares of XYZ company, then it's a non-monetary asset. But if you have bought bonds, if you have invested in the debt instrument of XYZ company, then it's a monetary item. So one is false, other two are true. Let's see. In relation to IAS 21, the effect of changes in the foreign exchange, which of the following statements are true? So can I say the two statements are true? Second and third. Second and third. I hope it is clear to everyone. Now let's go ahead. Any question? Thank you. What is the total loss arising to the nearest thousand on the above transaction in the year ended December X1? What is the total loss? Let's see. An entity took out a bank loan for 12 million dinars. Bank loan is a monetary liability on January X1. It repaid 3 million dinars to the bank on 30th November X1. So out of 12 million dinar, they have repaid 3 million. So obviously on repayment, there will be exchange gain or loss that goes to P&L. The remaining loan you have to retranslate on SOF period by using closing rate because it's a monetary liability. The entity has a reporting date 31st December X1 and a functional currency is the dollar. Exchange rates they have given us. Okay, fine. Now let's see. First of all, look at the exchange rate. It is actually 6 dinars to $1. It means that dinar is a weaker currency as compared to dollar. Dinar is a weaker currency as compared to dollars. Number one, this is what you need to know. Why dinar is weaker as compared to dollar? You can see the ratio. 6 dinars, they are equal to $1. So obviously, more dinar, they are equal to $1. So then dinar is a weaker currency, dollar is a stronger currency, number one. Number two, now, when I'm going to convert this 12 million, dinar to the dollar, so obviously, when I'll be converting weaker currency to the stronger currency, so the amount which is written in the weaker currency, when that will be converted into the stronger currency, then amount in the stronger currency will be less than $12 million. So simply, I'll take the $12 million. We are required to ignore how many zeros? 3 zeros. So I'm taking 12,000 divided by 6. So in day one, the amount of the loan in dollars will be 2,000. And there is one more way of understanding, do I need to divide or multiply? Another way is also available. If I just give you, first let us try to solve this, then I'll give you the another understanding also. How to decide, do we need to multiply or divide? It's up to you. Choose any one of them. Right now, logically on 1st January, X1, we have taken a loan. We are ignoring 3 zeros. Let's say cash or bank debit by $2,000. And the bank loan, which is a monetary liability, credited by $2,000. Okay. Then what is happening? Company repaid 3 million dinars to the bank on 30th November X1. So 30th November X1. How many dinars we repaid? 3,000. We are ignoring 3 zeros. Okay. The exchange rate on this date was 5. So 3,000 divided by 5 will give us $600. If I'm not wrong, let me recheck as well. Yes, we're getting $600. Okay, now try to understand. We have already converted 12,000 dinars and they converted into $2,000. In day one, we have used the exchange rate 6. We have not repaid all the dinars. Out of 12,000, we have just repaid 3. So initially, logically, 3,000 dinars, technically they were converted by using the rate 6. So initially they were equal to $500. But when we repaid the 3,000 dinar on that day, the amount is $600. So logically, there is an exchange loss of $100. It means on 30th November X1, on 30th November X1, bank loan is debited by $500. But how much we are paying? We are paying $600. So there's a exchange loss of $100. Obviously, that exchange loss goes to P&L, income statement, because we are dealing with monetary liability. Okay. There's other way also if you want to deal like this. Someone can say that out of 12,000, we have paid 3,000 dinars. So if I just calculate a percentage, 3,000 divided by 12, it means 25% of the liability I have paid. By paying 25% of the liability, how much we paid? $600. Now come here. This is your 100% liability. Out of this, you have paid 25%. If I take 25% of 2,000, it is coming $500. In order to pay the liability of $500, actually we are paying $600. So we are having an exchange loss of $100. So it is up to the student how student wants to deal with that. Now, we are left with 9,000 dinars. Why 9,000 dinars? Because out of 12, we have just paid 3. And bank loan is a monetary liability. So we have to retranslate the remaining loan by using closing rate. Closing rate means exchange rate on SOFP date, which they have given us 5.6. Simply 9,000 divided by 5.6, that gives me 1607. Initially, the entire 9,000, they were translated by using the rate 6. So logically, your 1,500 loan now, it becomes 1,607. So rise in the loan is a loss for the company. So this 107 is an exchange loss. It means that on 31st December X1, exchange loss will be debited by 107 and the bank loan will be credited. So the total loss is 100 plus 107. Because they've asked us the total exchange loss. So total exchange loss is 207. I hope it is clear to everyone. One more thing, if any one of the student is having difficulties in translating them by using the ratios, but I would prefer ratios, but there's other way also. That is, if you have been given indirect quote, how do we decide indirect quote? In the numerator, you will have a foreign currency. In the denominator, you will have a local currency. The sign of local currency will be in the denominator. Like in this question, it is logically dinar per dollar. Indirect quote. Indirect quote, the rule of translation is division. We divide. So if the question is in indirect quote, so while translating, you will be dividing it. If question is given to you is having a direct quote, how will you identify the direct quote? Local currency exchange rate sign will be in the numerator, and in the denominator, you will be having a foreign currency. Then rule of translation becomes multiplication. Now, obviously, it is up to the student. Either deal with translation by using indirect code where we divide, and use direct code where we multiply, or just go by the ratio. And let me tell you one more thing. Whenever examiner gives you this one is actually always represent the denominator. One always represents the denominator. So I hope this will help you. What is the carrying amount of the machine on December 31st, December X1? Carrying amount of the machine, okay? A manufacturing entity buys a machine, an item of property, plant, and equipment for 20 million dinars on 1st January X1. The machine is held under the cost model. Useful life is 20 years. The entity has a reporting date 31st December X1. Functional currency is the dollar. Now you can see that indirect code, because in the numerator we are having a foreign currency, in the denominator we are having a local currency. We bought the machine on 1st January X1. The rate was 2 dinar into $1. Again, dinar is a weaker currency, dollar is a stronger currency. The amount which is written in the weaker currency, when that will be converted into dollar, so amount will become, obviously then answer in dollar will be less. Again, you are not going by ratios, then simply it's an indirect quote. In indirect quote, for translation, we divide. So we'll take 20 minutes, 1st January X1 machine, 20 million divided by 2. We'll get $10 million. Okay. Average rate, actually, we have nothing to do with the average rate. Average rate is actually used if you have accrued interest income. You will be using average rate. For interest income, for interest expense, we use average rate. One more area where we use average rate, if you have a foreign subsidiary, then when we translate SOCI of a foreign subsidiary, then we use average rate. So where do we use average rate? In case there's a possibility you have taken a loan in foreign currency, so obviously you will be paying interest in foreign currency. Then that interest will be translated by using average rate. Another area, if you have invested in the XYZ company's debentures, you will be but that investment is in a foreign company's debentures, you will be getting interest income in foreign currency. That interest income will be translated by using average rate. One more area, that is overseas subsidiaries, SOCI is translated by using average rate. Right now in this question, there's no work of average rate at all. They're using cost model. The life is 20 years. So simply deduct the depreciation. 10 million divided by 20 will have 0.5 million depreciation. So the carrying amount December X1. Carrying amount means simply net book value. So the net book value of the machine is 9.5 million. So net book value of the machine is simply 9.5 million. Okay. Now let's go ahead. What items should be recorded in the statement of profit or loss for the year ended December X3? What items should be recorded in the statement of P&L? Let's see. Mango sold an item of maturing inventory to a bank on 1st January X3 for $500,000. Okay. At this date, the inventory had a cost 2 lakh to produce, but had a fair value 900,000. Now stop. There's a big question. Okay, any question here? Just a minute. Do we get the recording? Yes, as I mentioned, today's recording will be uploaded on YouTube channels, and obviously those students they are enrolled with us, they will get the recording. They will get the recording. Actually, it's a revision class, and definitely everyone is appearing in an upcoming session. So I hope you people have revised all this. But during any MCQs, if you have any question, you are more than welcome to ask. There's no harm. I'll reply. No issue at all. You can ask. No issue at all. Now, please try to understand. Mangoes sold an inventory for $5 lakh. Till here, everything is fine. Inventory had cost 2 lakh to produce, but look at the fair value. So don't you think so? It's a little bit suspicious transaction. Why would you sell an inventory for 5 lakh which had a fair value $900,000? Why? Why would somebody will do that? When the fair value is 9 lakh, you are selling it for 500,000. Let's read. Which was expected to increase over the next 3 years, and that will increase even more. At the end of 3 years, Mango have the option to repurchase the inventory at 6 lakh 65,500, giving an effective interest rate of 10%. Now, please try to understand. Logically, by applying here, obviously, we'll apply the substance over form. So, we'll say actually, Mango has not sold the inventory. Mango has actually taken the loan of 500,000, and over the 3 years time, they will actually repay the loan principal with interest. Why we are saying this is not a sale at all, it's a loan? Because read the question nicely. It says Mango sold it for 5 lakh inventory. Till here is fine. But after that, the question says the fair value is 900,000. Why would you sell an inventory which has a fair value 9 lakh for you're selling it for 500,000? And after that, you are saying it will keep increasing. It will keep increasing as well. And at the end of 3 years, Mango is having the option to repurchase the inventory for 6,65,500. So simply we'll say that it's a substance over form scenario. Day one, actually, if you ask the double entry, we'll say simply cash or bank debit and loan credit. Then on that loan at the end of the year, we'll record an interest expense. So simply 500,000 into 10%. End of first year, the interest expense will be 50,000, and that interest expense you will take to the P&L. Interest expense, finance cost. So here you will apply the concept of substance over form, because nobody will sell an inventory which is having a fair value 9 lakh for 500,000. And then the question says the inventory value will keep increasing as well. So examiner has tested here, I would say, substance over form scenario. Okay. Which of these has been correctly included? Which of these has been correctly included in revenue? According to IFRS 15, revenue from contracts with customer. Which of these has been correctly included in revenue according to IFRS 15, revenue from contracts with customers? If you just recall, IFRS 15 actually gives us a 5 steps model. First, you need to identify the contract, then identify the performance obligation, then you need to check how many performance obligations are there, then transaction price, then we allocate actually different performance obligations We allocate the transaction price on the basis of separate performance obligations, and then at the end, in step number 5, we actually recognize the revenue. Repro has prepared its draft financial statement for the year ended 30th September X4. It has included the following transaction and revenue and amounts stated below. Let's see. Number 1, it says agency sales 2,50,000, on which repro is entitled to a commission. Now listen, which of these has been correctly? You have to tell us which one is correctly recorded. When you are working as an agent, then you can only recognize commission income, nothing else. They are saying something else. Why of the first one is false? Because you are not recognizing only the commission income. Look at this. You are saying agency sale 2,50,000, which repro is entitled to a commission. You should have recognized only 10% of that, not the entire sale. That is why the first one is false. Sale proceed of $20,000 for motor vehicles which were no longer required by repro. Can I say, when we say revenue means when you are selling your inventory, when you are selling your stock. Sale of fixed asset is not treated as sale. It is not added in your revenue. Basically, when you are selling a property, plant and equipment, when you are selling a fixed asset, either there will be gain on disposal or loss on disposal. That gain or loss actually goes to income statement SOCI. The sale proceed of fixed asset does not go to the sale amount. So B is incorrect. Now, sale of 1,50,000 on 30th September X4. The amount invoiced to and received from the customer was 180. You received 180. You have recognized the revenue 150, which includes $30,000 for ongoing service work to be done by repro over the next 2 years. Can I say the C makes sense? Try to understand. The amount invoiced to and received from the customer is 180. But how much revenue you have recognized? 150 immediately. Remaining $30,000 actually belongs to the ongoing services work to be done by repro over the next 2 years. So logically, the remaining 30,000 should be recognized as revenue, but over next 2 years, not right now. C is logical, true, but let's see the last one as well. Sales of 200,000 October X3 to an established customer. To an established customers, okay, who with the agreement of repro will make a full payment on 30th September X5. Repro has a cost of capital 10%. Sale of 200,000 first October X3 to an established customer, but when you will be getting a payment? You will be paid on 30th September X5. Can I say in that case, you should be recognizing the revenue at its present value, not the value which you will be getting after 2 years. So logically, this question, option C is correct. Okay. What amount would be reported as a contract asset in yielding statement of financial position? 30th September X4. Actually, when your revenue is more and amount which you have billed is less, then difference will be simply your contract asset. Yielding entered into a contract to construct an asset for a customer on 1st January X4, which is expected to last how many months? 24 months. The agreed price of the contract is 5 million. Agreed price is 5 million. At 30th September X4, the cost incurred on the loan were 1.6 million. And estimated remaining cost to complete was 2.4 million. On 30th September X4, Yilling received a payment from the customer 1.8 million, which was equal to the full amount of billed. Okay. Yilling calculates contract progress using input method on the basis of costs incurred compared to the total estimated cost. They calculate percentage of completion on the basis of input method, simply cost incurred divided by total cost. So let us first calculate percentage of completion. Cost incurred is 1.6 million and the total cost is 1.6 plus 2.4. Let's use the calculator. 1.6 divided by 4, I'm getting 40%. So logically, percentage of completion is 40%, which means that how much revenue we should recognize? 40% of the transaction price. 40% of the transaction price, which is 2 million. Amount bill, what is the amount bill is 1.8. So you can see that amount bill is less, revenue earned is more. So you can say there's a contract asset of 0.2 million. This is a contract asset of 0.2 million. So first we have calculated percentage of completion. Then we check how much revenue we have earned. Revenue earned is more, amount bill is less. So difference is simply your contract asset. Okay. Select the correct amounts to be shown in revenue and cost of sale in the statement of profit and loss for the year ended 31st March X5. Select the correct amounts to be shown in revenue and cost of sales in the statement of P&L for the year ended 31st March X5. Let's see. CN started a 3-year contract to build a new university campus. On 1st April X4, the contract had a fixed price 90 million. The contract price is 90 million. CN will satisfy the performance obligation over time. CN incurred cost to 31st March X5 77 million. So the cost incurred is 77 and estimated that further 33 million would need to be spent to complete the contract. Now something is very interesting. Look at this. Cost incurred is 77. Further they will be spending 33. 77 plus 33, the total cost is 100 million and the fixed price is 90. It's a loss making contract. And according to IFRS 15, if you entered into a loss making contract, then entire loss will be recognized in the first year. In case of loss, you will not recognize over the period of time. So your contract price is 90. Costs incurred, they have given us 77 million. Then estimated future cost, 33. So there's a loss of 20 million. So entire loss of 20 million, make sure should be shown in a very first year of the contract when you will be preparing financial statement. So simply 20 million will be recognized in first year. Immediately you can say. Okay. CN measures the progress of the contract using work completed compared to the contract price. At 31st March X7, survey valued the completed to date 63 million. So let us first calculate percentage of completion. This is also called output method. Value of work completed is 63 million. Contract price is 90 into 100. 63 divided by 90. I'm getting 70%. So the percentage of completion is 70%, which means that if you ask the revenue will be 90 into 70%. We'll get 63. Am I right? But the point is, final result, we need a loss of 20 million. If we need a loss of 20 million, simply your cost of sale, you can say it's a balancing figure. Because in a very first year, you have to recognize the entire loss. The entire loss is you need to recognize immediately. Cost of sale is a balancing figure. Balancing figure. Logically 83. Because if the revenue is 63 and we need the entire loss of 20 million, it is only possible when cost of sale is 83. Now let's see the choices. Revenue. Can I say logically revenue is 63, but the cost is 83. So it is not always that 63, then you go for 77. No, 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 no. Revenue is 63, the cost has to be 83. Okay, now. According to IFRS 15, revenue from contracts with customers. How much should Locke record in revenue for the year ended December X1? Working should be rounded to the nearest dollar. Okay. Locke sells machines and also offer installations and technical support services. They're doing 3 works if you see that. They're selling machines, installation, technical support services. The individual prices of each product are shown below. Price of the machine, price of the installation, 1 year service. If you add all of them, 75 plus 30 plus 40, we're getting 150. Locke sold a machine on 1st May X1, charging a reduced price of $100, including installation and 1 year service as well. So there's a really big discount. Locke only offers discount when customer purchase a package of products together. Fine. According to IFRS 15, revenue from contracts with customer, how much revenue of Locke recorded in revenue for this year? Now listen. The revenue which relates to sale of machine will be recognized immediately. The revenue of installation will be recognized immediately. But the revenue which relates to 1 year service, this will be recognized over 12 months. And the date of sale is 1st May X1. From 1st May X1 till December X1, the time period which has been passed is 8 months. So the revenue which belongs to 1 year service, whatever the amount of that revenue is, only 8 months revenue will be recognized till December X1. Now what we have to do, we have to allocate the transaction price on the basis of stand-alone separate performance obligation prices. Machine separate price is 75, installation separate price is 30, 1 year separate price is 45. Now let's see how much revenue belongs to the machine. I'll take 75 divided by 150 and the transaction price is 100. 75, 150, that 50%, 50 million. Obviously, this 50 will be recognized immediately, you can say. The installation one, 30 divided by 150 into 100. How much revenue belongs to the installation? That's 20. So obviously the entire price is 100. Out of 100, 50 belongs to the sale of machine, 20 belongs to the installation. So remaining 30 actually belongs to 1 year service. Otherwise, you can do one thing, 45 divided by 150 into 100, definitely we will get 30. So this 50 will be recognized, 20 will be recognized, but the revenue which belongs to 1 year service, which is 30 million, this 30 will be recognized over 12 months. Out of 12, 8 months have passed. So 30 multiplied by 8 upon 12, I'm getting 20. So it means December X1, the revenue which will be recognized is 50 plus 20 plus 20, that is 90 million. And this is what they have asked us. So you will recognize the revenue net. Place the following steps for recognizing revenue in accordance with IFRS 15. If you recall, we said IFRS 15 actually has given us a 5 steps approach. Number one is identify the contract, then identify the separate performance obligation. Then you need to decide the transaction price. Then we allocate the transaction price according to the separate performance obligation. And then finally, we recognize the revenue. Actually, revenue is recognized in step 5. So identify the contract is number one. Number one is identify the contract. Then I need to know the performance obligations. Identify the separate performance obligation within the contract. Then determine the transaction price. Allocate the transaction price to the performance obligation, and then finally we will recognize the revenue. Actually, revenue is recognized in the last step. Okay, now applying IFRS 15, revenue from contracts with customers, how much revenue and cost of sale should BL recognize in its statement of profit and loss for the year ended October X5. Applying IFRS 15, revenue from contracts with customers, how much revenue and cost of sales should BL recognize in the statement of P&L for the year ended October X5. Let's see. BL entered into a contract with customer on 1st November X4. The contract was scheduled to run for 2 years and sale value is 40 million. BL will satisfy the performance obligation over time. At 31st October X5, at the year end, the following details were obtained from the BL records. Cost to date, they have given us 16. Further cost is 18. Progress is 45%. Okay. Look at this. Revenue. I'll take 45% of this. I'm getting 18. Plus, we need to check also, is it a loss-making contract? I don't think so. If you add 16 plus 18, look at this. It's not a loss-making contract, it's a profitable contract. Because in case of a loss-making, there's a profit of 6. Because in case of a loss-making contract, we know that you have to recognize the entire loss immediately. It's a profitable contract, so obviously profit will be recognized over time. So revenue is 18, and then we just need to recognize the cost to date, cost incurred to date. Cost incurred to date. So basically cost incurred to date is your cost of sale and the revenue is 18. Let's see. Revenue is 18 and revenue is 18. Cost to sale is simply cost incurred to date. Okay. What is the closure provision that should be recognized? Closure provision. Now, students, when examiner says closure provision, actually IAS 37 should come in your mind. IAS 37, if you recall. Let's see. And according to IAS 37, the provision which actually relates to the restructuring, only that will be recognized. ABC has a year-end 31st December X4. On 31st December X4, the directors publicly announced their decision to close an operating unit and make a number of employees redundant. Some of the employees currently working in the unit will be transferred to other operating unit within ABC. The estimated costs of closure are as follows. Redundancy costs, yes. Actually, the provision of closure, or you can say the provision of restructuring, will have only that cost which is the result of restructuring. So obviously redundancy costs we will bear because of the restructuring, so it's okay. It will be a part of provision. Lease termination, of course, if I'm going to terminate this contract because of the closure, so I'll take that also to the provision. Relocating of continuing employees to the new location, it cannot be a part of closure because it's just an ongoing activity. You have what is written? Relocating. You're just relocating employees from one place to another place. It shows an ongoing activity. It cannot be a part of provision. Retraining continuing employees, again, is not a part of closure. Again, it's an ongoing activity. So logically, the provision amount should be 1,000, or you can say 1 million. So only according to IAS 37, provision of restructuring will only have the cost which is the result of restructuring. But a relocating cost and retraining cost, that's not a part of restructuring. It shows actually ongoing activities. Okay, let's see this one. What is the total provision? Extraction plus dismantling. Extraction plus dismantling. Again, of course, IAS 37. Which explorer would report in its statement of financial position as at 30th September X4 in respect of oil operations? We need a total provision relating to two things, extraction plus dismantling. If you recall, in case of dismantling, what do? We first calculate the present value of dismantling cost, property, plant and equipment debit, provision credit. Then, due to unwinding of discount, that provision amount increases. Let's read the question. On 1st October X3, explorer commenced drilling for oil in an undersea oil field. The extraction of oil causes damage to the seabed, which has a restorative cost, ignoring discounting. Okay, that's thank you, examiner. Here, examiner is saying ignore discounting as far as restorative cost is concerned. Take $10,000 per million barrel of oil extracted. So if 1 million barrel are extracted, then you have to bear the restorative cost of $10,000. Explorer extracted 250,000 barrels of oil in the year ended 30th September X4. Wow. 250 million. They don't want to leave for anyone else, I believe. 250, can I say multiply by 10,000? Let's use the calculator. All we need is just Add 4 zeros. $2.5 million. But that only belongs to restorative cost. Explorer is also required to dismantle the drilling equipment. At the end of its 5-year license, this has an estimated cost 30 million. On 30th September X8, Explorer cost of capital is 8% per annum. $1 has a present value $0.68 or 68 cents in 5 years time. Now listen. Right now we are at 1st October X3. Present value of dismantling cost. We'll take 30 million into 0.68. So 30 million into 0.68. Then gives us 204. 20.4 million you can say. Now till year end, 30th September X4. Due to unwinding of discount, this will increase. Cost of capital is 8%. So if you ask the double entry of the present value of dismantling cost, your property, plant and equipment debit, provision credit. But this provision will increase due to unwinding of discount, 1.08. Multiply this with 1.08. I'm getting 22 million and 32,000, I believe. They're asking us the total provision, extraction plus dismantling. Extraction one is here, 2.5 million. Let's add. So I'm getting students 24 million, I would say 24532 000. 24.532 million, I believe. Let's check the choices. Choice is beta. You can see that. Ours is a good question. Okay. Which two of the following events which occur after the reporting date of an entity but before the financial statements are authorized for issue are classified as adjusting events in accordance with IAS 10. Student, we have seen question on IAS 21, IFRS 15, IAS 37. Now we are on IAS 10. Which two of the following events which would occur after the reporting date of an entity but before the financial statements are authorized for issue are classified as adjusting events in accordance with IAS 10, events after the reporting date? Actually, adjusting events are those events where on SOFP date, we do have the information of their existence. Only the confirmation comes after the year end. Such an event as an adjusting event. A change in the tax rate announced after the reporting date. Ganesh is a non-adjusting event. Change was not announced before the year end, it was announced after the year end. So obviously we did not have any information like there will be a change in the tax rate. The discovery of a fraud which had occurred during the current year. Obviously an adjusting event. Discovery of a fraud is always an adjusting event which occurred during the year. The determination of the sale proceed of an item of a plant sold before the year end. Adjusting event. Actually, we sold the plant before the year end, only the price was decided later on. The determination of the sale proceed of an item of a plant sold before the year end. And the last one is destruction of a factory by fire. Can I say non-adjusting event? On SOFP date, we did not have any knowledge, any information that there will be a destruction of a factory by fire. Okay, now let's come here. Students, so far, whatever questions we have discussed, I've taken those questions from Kaplan kit. Now let's see. A piece of machinery cost 5 lakh. Tax depreciation to date has been amounted to 2,20,000, and depreciation charge in the financial statement is 1 lakh. The rate of tax is 30%. Which of the following statement is incorrect in accordance with IAS 12? Now listen, first of all, in case of assets, if carrying amount is more, tax base is less, then difference is a taxable difference. Your difference is taxable temporary difference. Taxable temporary difference multiplied by tax rate will give you deferred tax liability. If carrying amount of asset is less, tax base is more than carrying amount. Difference is a deductible temporary difference. Deductible temporary difference into tax rate gives you deferred tax asset. And this relationship is exactly opposite for the liabilities. Repeat. This relationship is exactly opposite for the liabilities. Cost of the machine is 5 lakh. Depreciation charged by the company is 1 lakh. So logically, carrying amount is 400,000. This is the carrying amount. 500,000 minus the tax depreciation, which is 220. So logically, the tax base is 280. So carrying amount is 4 lakh. Tax base is 280. Difference is 120, and that difference is a taxable temporary difference. Let's see the tax rate. Have they given us any tax rate? Yes, 30%. Taxable temporary difference into tax rate gives us deferred tax liability, which is 36,000. So logically, the carrying amount is 4 lakh, tax base is 2 lakh 80. Difference is a taxable temporary difference, 120 multiplied by 30%. The deferred tax liability is 36,000. Now let's check. And this time they're not asking us which one is correct. They're asking us which of the following statement is incorrect. Incorrect. The deferred tax liability in relation to the asset is 36. Can I say this is correct? But that is not our answer. Why? Because the question is tell us which one is incorrect. Tax base of the asset is 280. Correct. Can I say this is incorrect? Why it is incorrect? They are saying deductible difference. According to our relationship, the difference is taxable. When asset is having a carrying amount more than tax base, difference is taxable, not deductible. That is why the C is incorrect. There is a taxable temporary difference, that is correct. But answer is C. Why C? Because examiner has asked us to tell me which option is incorrect. Okay, what is the income tax expense that will be shown in the statement of profit and loss? Now listen. Taxation T account brought down current tax plus deferred tax. Carried down current tax plus deferred tax. Then you will get the tax which is charged to P&L. Now, there's a possibility that if there is a revaluation surplus, due to revaluation surplus, whatever deferred tax liability comes, we charge that to OCI. Because according to IAS 12, if the deferred tax liability is coming due to revaluation surplus, you will have to charge to revaluation surplus. So there's a possibility you might be having impact of deferred tax in OCI. And one more thing, if current tax balance is coming on credit side, it shows over provision of income tax. Sometimes this is also possible that BD of current tax comes on debit side. If the BD brought down of current tax comes on debit side, then it shows the under provision. And logically, you need to know one more thing. Over provision actually reduces current year income tax expense. Under provision actually increases current year income tax expense. Okay. Sometime you will get a balancing figure here, which is tax paid. And let me write that statement also. Income tax over provision. What it does, it reduces income tax expense. So in the previous year, if you've made any simply over provision of previous year, reduces income tax expense of current year. For example, if the previous year is 2024, then the impact you will get this in 2025. Now, under provision of previous year, under provision of previous year increases income tax expense of current year. Again, if previous is 2024, then you will have the impact this one in 2025. Now let's apply in the question. Taxation. Over provision is credit balance, under provision is debit balance. Okay. Toll Limited accounting records shown the following. Income tax payable for the year is 60,000. Over provision in relation to the previous year is 4,500. Opening deferred tax liability is 2,000. Income tax payable for the year is 60,000. Closing deferred tax liability is 3,200. 63,200. Obviously, we should be having 63,200 here also. Balancing figure, which is your income tax expense. Let's see. From 63,200, we will deduct 4,500 plus 2,600. I'm getting 56,100. Delta. What figure will be shown in the statement of comprehensive income for the year ended 30th September 2021 in respect of income tax? Okay. The following information has been extracted from the accounting records of the Candle Limited. Estimated income tax for the year was 2020 was 75,000. Income tax paid was 80. Now listen carefully. In 2020, year 2020, company recorded current tax expense 75. Let's say current tax payable 75. But when the time of the payment came, normally we do not pay the income tax payment in the same year when we have recorded. Let's say 2020 payment will be made in 2021. Actual payment was more than what you have recorded. Current tax payable was 75. But actual payment, your tax payable debited by 75,000, but you have actually paid how much? 80. So you have recorded 75, but your actual payment is 80. It means in the previous year you recorded less. There's an under provision of 5,000, and due to under provision, your income tax expense of the current year will increase. Income tax expense of 2021, which is the current year for us right now, income tax expense will increase. So this 5,000 will increase your current year income tax. Estimated income tax for the year is 83,000. With this, within this 83, we will add 5,000, which is under provision. Why under provision? Because previously we recognized provision 75, but actual payment was more than that. It means we recorded less under provision. So logically, income tax expense should be 88 million. Okay. What is the charge for taxation that will appear in the statement of P&L for the year ended 30th June 14? What is the charge for taxation? Let's see. Home Limited has the following balances, including a trial balance. Taxation balance relate to an over provision. So they are giving you over provision. They mention also credit side. At 30th June 14, the director estimate that provision necessary for taxation in the current year is 15 million. The carrying amount of HL non-current asset exceeds the tax written down value. Student, we have just discussed, if carrying amount is more and tax base is less, carrying amount is more, tax base is less, difference is your taxable temporary difference. Taxable temporary difference multiplied by tax rate will give you the closing deferred tax liability. So if I just ignore 30 for this simplicity, you can say your closing deferred tax liability is coming 9 million. What is the charge for taxation that will appear in the income statement, P&L? Brought down, we are ignoring 30. 3 zeros. Current tax is 4,000, deferred is 12. Current is 15, deferred we have calculated 9. 15 plus 9, 24. It has to be 24 here. Simply balancing figure is your income tax expense, which you have to show in the income statement, 8,000 if I'm not wrong. That is 8 million. Okay. Vast Limited assistant accountant has discovered there is a debit balance on the trial balance 3,000 relating to, can I say debit balance represents the under provision we have just discussed. Debit balance shows the under provision, and under provision what it does, it actually increases your current year income tax expense. Debit balance shows the under provision. What will be the impact? What impact will this have on BL current year financial statement? Increase the tax liability. Actually, it does not increase the tax liability, it increases the current year income tax expense. Decrease the liability. No. Increase income tax expense in the statement of P&L. True. Decrease tax will not be decreased. Tax decreases due to over provision, not under provision. What amount will be shown as income tax in the statement of P&L? A company's trial balance shows a debit balance. Debit under provision. Brought forward on current tax, credit balance, deferred tax is 5.4. The tax charge for the current year is a statement is 16.2. Carrying amount of net asset 13 million in excess of their tax base. Again, if carrying amount is more than the tax base, difference is taxable temporary difference multiplied by 30%, will give you the closing deferred tax liability, which is 3.9 million. You can see that under provision is actually increasing your current year income tax expense. So 2.1 plus 16.2 plus 3.9. 22.2 million. It has to be 22.2 million. Oh no. Just a minute. P&L. Students, in the P&L, I'm getting 16.8 million. Okay. Question number 7. I want everyone to attempt this question number 7 because you have seen it's a similar question which we have already done. Let's see. I'm giving you 3 minutes to do it. And let's see who is going to reply. You have 3 minutes to attempt. Okay, what are they asking? Let's see. What is the profit or loss in the income tax charge for the year ended December 30? A company's trial balance December 13 shows a debit balance. Again, everything is in millions, so 0.7. Current account, credit balance on deferred tax 8.4 million. The director have estimated provision for income tax for the year is 4.5. Deferred tax provision and deferred tax provision is 5.6, comma rupees 1.2 million of which relate to property revaluation. Can I say the deferred tax which relates to the revaluation that is charged to OCI? So let's see the balancing figure which you have to show in the P&L. 0.7 plus 4.5 plus 5.6. I'm getting 10.8. P&L is 1.2. We have already discussed that when a deferred tax liability arises from revaluation surplus, then it will be charged to revaluation. What is the deferred tax liability required by IAS 12 income tax December 18? The following information relates to an entity. We just need to calculate the deferred tax liability. Okay. January X1, the carrying amount of non-current asset exceed their tax written down value by this. Carrying amount, tax base, temporary difference, non-current assets. It says non-current assets, carrying amount of non-current asset exceed their tax return on value, means carrying amount is more, tax base is less. Can I say 8,50,000 is a taxable temporary difference? 8,50,000 is a taxable temporary difference. Okay. For the year ended December 18, the entity claimed depreciation for the tax purposes 5 lakh and charged depreciation 450 in the financial statements. Please read it. For the year ended December 18, entity claimed depreciation for tax depreciation is 5 lakh. Charge depreciation is 4 lakh 50 in the financial statements. Now, for example, just an example. Assuming that property, plant and equipment is having cost 1 million. I'm just assuming. Accounting depreciation is 450. Which means that carrying amount will be 550. Property, plant and equipment 1 million. Tax depreciation is 5 lakh. So the tax base is obviously also 5 lakh. Now listen, carrying amount is more, tax base is less. So difference is 50,000 and that difference is also representing taxable temporary difference. I have just assumed that property, plant and equipment is having a cost of 1 million. Accounting depreciation is 450. 1 million minus 450 gives us the carrying amount 5 lakh 50. Again, cost is 1 million. Tax depreciation is 5 lakh. So the tax base is 5 lakh. Carrying amount is more, tax base is less. The difference is taxable temporary difference. So due to transaction number 2, we also have a taxable difference of 50,000. Taxable temporary difference of 50. During the year December 18, the entity revalued a property. The revaluation surplus is 2 lakh 50. There are no current plans to sell the property. Now, listen carefully. Due to revaluation, you have increased your carrying amount. Taxation authorities, they don't accept revaluation surplus. Now, what happens? Carrying amount of your asset will increase by 2,50,000. Tax authorities will not increase their tax base by this revaluation surplus because taxation authorities do not accept revaluation at all. So repeat, carrying amount will increase by the revaluation surplus. Tax base will not increase due to this revaluation surplus. So logically, this 2,50,000 of revaluation surplus will also result in taxable temporary difference. Repeat. Revaluation, due to revaluation surplus, property, plant and equipment will increase by 2,50,000, but this 250 will not increase the tax base because taxation authorities do not accept revaluation surplus. So obviously carrying amount will increase by 250, tax base will not increase. So we can say that carrying amount will be more than 250 as compared to tax base. Again, there's a 2,50,000 difference, which is a taxable temporary difference. Of course, we know that due to this 2,50,000, whatever the deferred tax liability comes, that will be charged to OCI, that will be charged to revaluation surplus. But examiner is not asking this. This time examiner is asking us what is the amount of your deferred tax liability. So simply all taxable temporary differences will be added. Then into tax rate will give you the deferred tax liability which we need to calculate. All our taxable temporary difference, tax rate is 30%. So deferred tax liability is 3,45,000. They're not asking how much will go to PNL, how much will go to OCI. If they were asking, then obviously 2,50,000 multiplied by 30% will go to OCI and remaining will go to PNL. But they are asking in this question, give us the deferred tax liability amount. So the deferred tax liability amount is 3,45,000. The accountant of an entity confused by the term actually tax base means value of your assets or liabilities according to taxation authorities. Tax base means value of the company's assets or liabilities due to tax authorities. What is meant by tax base? The amount of tax payable in the future period falls. Tax regime under which an entity assesses the tax, the amount attributed to an asset or a liability for tax purposes, the amount of tax deductible. Okay, now, what is the amount of deferred tax expense or income in respect for the year ended 30th June 2018? Read the requirement first. What is the amount of deferred tax expense or income in respect of the above for the year ended 30th June 18? Let's see. Orange Limited is in the process of finalizing its financial statement for the year ended 30th June 18. Orange Limited sells goods with a 1-year warranty, and it is estimated that warranty expenses are 2% of annual sales. Actual payment during the year related to the warranty claim were 54 million. Of these, 38 million pertains to goods and sold during the previous year. Opening balance of the provision for warranty was 49 million. Sale for the year ended 30th June 18 was 1750 million. Under the tax law, these expenses are allowed on payment basis. Applicable tax rate is 30%. Now read the requirement again. They are asking what is the amount of deferred tax expense or income in respect of the above for the year ended. Now listen. The sale is 1750. 2% of that is your warranty provision. Warranty provision of the current year, which is 35 million. The story does not end here. Actual payment during their actual payment is 54 million. During their actual payment is 54 million. Out of this 54, 38 million belongs to the previous year. So it means 54 minus 38. That belongs to the current year. Now logically, please listen carefully. The warranty provision is 2% of the sale. The current year sale is 1750. If I take 2% of that, it is coming 35. But out of that 35, the provision of the current year, how much we have paid? 16 million. It means warranty provision. This 19 million warranty provision you will show in your current year SOFP. Current year SOFP. Carrying amount, tax base, temporary difference. Warranty provision in the current year will be 19 million. Tax base is 0. Why tax base 0? Because taxation authorities do not accept warranty provision. And warranty provision is a liability. So 19 million will represent a deductible difference. I've already explained you. The relationship for liabilities is exactly opposite of asset. Deductible temporary difference. And deductible temporary difference multiplied by tax rate will give you deferred tax asset. This 19 million is a deductible difference. Tax rate is 30%. Just to differentiate the taxable and deductible difference, we just represent deductible difference in negative and taxable as positive. Logically, 19 million multiplied by 30%. 5.7 is your closing deferred tax asset. From this closing deferred tax asset, we will deduct opening balance. Let's see what was the opening. Opening balance of the provision was 49 million. So opening balance of the provision was 49. Again, the carrying amount 49, tax base 0. So 49 million was an opening deductible difference multiplied by tax rate. Opening deferred tax asset is 14.7. Closing deferred tax asset is 5.7 less opening deferred tax asset, which is 14.7. So you can see that your asset is not increased, it has decreased. If there is decrease in asset, it is your income tax expense, the deferred tax expense. So 9 million is not income. If there is a decrease in the liability, it is deferred tax income. If there is a decrease in asset, it is deferred tax expense. So basically closing asset is less than the opening asset. So there's a deferred tax expense of 9 million. It's a very good question, I would say. So there's deferred tax expense, deferred tax expense. Okay, that's the last question of today's class. And in today's class, we did discuss IAS 21, IFRS 15, IAS 37, IAS 10, and then IAS 12. So almost 5 IASs, you can say. 4 IASs, 1 IFRS we have seen. Okay, what are they asking? What is the amount of current tax after considering above information for the year ended 30th June 18? Amount of current tax. Let's see. Orange Limited is in the process of finalizing its financial statement for the year ended 30th June 18. Profit before tax is 508. Actually, this profit before tax through adjustment, we need to convert this into taxable profit. Taxable profit into tax rate will give you current tax. So we actually need to convert this profit before tax into taxable profit. Profit before tax is 508. Orange Limited sells goods with a 1-year warranty and it estimates warranty expense 2% of annual sale. Annual sale is 1750. Taxation authorities, they do not accept warranty provision. So they will ask us to add back the warranty provision. Add back. Warranty provision. 1750, I'll take 2% of that, which is 35. Provisions are acceptable by taxation authorities on payment basis. So actual payment during there was 54 million. No matter out of this 54 million, how much belongs to the previous year, since you have paid in the current year, entire payment will be treated by the taxation authorities as expense. Less provision paid. Provision payment, which is 54. Of this, 38 pertains to the goods sold to the previous year and the opening provision was 49. Now please try to understand. Orange Limited gives warranty only for 1 year. Previous year provision was 49 and actually we made a payment in the current year only 38. Now you need to understand one thing. Previous year, they made in 2017. In 2017, actually P&L was debited by 49. Warranty provision was credited by 49. In 2018, actually what happened? Debit and credit. Entire warranty provision 49 debit, but actual payment was only 38. Now try to understand, if your warranty provision, which is a liability, Your liability is 49 million, but you are actually paying only 38. It means there's a reversal of warranty provision by 11 million. Reversal of warranty provision. Reversal of warranty provision actually increases your accounting income. This 11 is will increase your profit before tax. So logically, there's a reversal of warranty provision by 11 million. Now this 11 has actually increased the accounting profit in the current year. Now listen, taxation authorities do not accept warranty provision as your expense, and similarly, taxation authorities do not accept reversal of warranty provision as your income. Since you have recognized the reversal of warranty provision 11 million as your income, taxation people, they will say, we don't accept this as your income. You need to deduct that. Less reversal of warranty provision. Now you will get the taxable profit. 508 plus 35 minus 54 minus 11. I'm getting 478. Tax rate is 30%. Students, I'm getting income tax expense, current tax 143.3, and this is what they have asked us. Again, I would say it's a very, very good question. A bit challenging question, of course. So students, that is all about today's first live revision class. We discussed IAS 37, IAS 21, the IASs which we have discussed. We started from 21, we went to, then after that 15, 37, IAS 10, and IAS 12. This is what we have revised today. Student, in the next class, we'll be discussing other IASs and IFRSs, and I'll take the question either from the study hub or BPB kit. But I'll give you the flavor of all sources of material so that you should have them. Like today, we discuss Kaplan and other area. In the coming class, there will be question from BPB kit as well as from a study hub. And plus, as I mentioned already, every Tuesday, 3 p.m. Pakistan time, I'll be conducting this live revision class. One more thing, in the entire FR, and this option is for everyone, in the entire FR, if you want any of the topic to be discussed in detail, so we can do that also. Plus, the coming Tuesday class will be little bit, I would say, will be longer than this. So you should be mentally prepared that coming class will be around 3 hours. So thank you very much that you people have taken out time for today's class. Hope to see you all, inshallah, in the next class as well.